Now looking at some of the results that are coming through from Kenya, East African breweries posted a 9% growth in first half pre-tax profit. That stock ended up 1.71% to 180 shillings. What did you make of those results?
I think they were very strong results by any standards. I mean, you realize that the operating environments across its markets have been very tough. You realize all these economies are at different levels of growth at the moment, and posting actually 36% growth in net sales. I think that was very strong, especially if you look at Kenyan markets, the regulatory environment not really looking favorable, and also macro environment, inflationary pressures, and actually cutting down on the disposable incomes. You would actually expect by any standards the top line to go down, but actually they beat that and returned a very strong, very strong turnover, and that's a good sign, you know.
The company has been pretty aggressive in growing its market share within the region, particularly in Tanzania. That market share is sitting at around 30%. What type of challenges has the company faced when penetrating that market? Well,
first of all, they had some what I call short-term marriage with the sub-miller that they had to end actually last year. And so they actually decided to go it alone, and they acquired a majority stake in Serengeti Breweries. They spent around a huge chunk of money buying Serengeti Breweries. And so you realize now that has actually put them in the direct competition with sub-miller, who actually own a majority in Serengeti's rival. So one of the challenges they have, obviously, is when they acquired Serengeti was to upgrade the production line to their standards. They had to splash out a huge amount of cash to just try to upgrade that line and get it to, decent standards, up to EABL, Diageo standard, you know. So and then again, the second challenge they had to bring on board sort of a very quality management team to run it, actually, to get it off and run it. So it's up and running. If you look at today's numbers, very decent contribution from Serengeti Breweries
George,
in the top line.
I'd like to touch on Kenya breweries. We know that EABL actually bought back the 20% stake from SAB Miller. One of the biggest issues when it comes to East African breweries is the fact that the Kenya operations is not as strong as it should be. A lot of competition within this space. Based on that premise, does this create a concern for you when it comes to actually exposing yourself to the stock, despite the fact that we've seen an overall very strong performance?
I think it was a good thing for them to buy back the 20% shareholding from sub-miller. Now, actually, it gives them a lot of teeth, to move strongly forward. Now they actually own the market 100%, so they can actually, forget about sub-miller and its contribution to the Kenyan operation, so they can actually go full throttle. It has a lot of upsides. Acquiring KBL, acquiring back the 20%, that share buyback was actually a very good move, and actually will give them a very good, a very powerful throttle. It has actually substantially enhanced their earnings power going forward, and I think it's a good thing. And actually, I would probably assign a very modest premium on the stock just based on the fact that they bought back that 20% share from sub-miller. And I think if you look at even the financing, they actually went for an intra-company loan, which I think was fairly cheap, not market, not subjected to market rates. So I think in terms of gearing on their books, it should be minimal.
So what is your strategy going forward with regards to the stock? Will you be holding, buying, or accumulating?
I'm accumulating ABL. I think the market should be accumulating the stock. Based on what I saw the first 6 months of operations, I think it actually we still have a very good second half. The next 6 months will still be very good, very good. Although the only challenge was that there was a forex component which is really eating into their margins, and actually it was very. I was surprised to see that 4% of their direct cost of goods sold was forex. They actually had to take a huge charge on forex, especially you realize that across the market they're operating in, the balance of payment pressures continues to pose a very substantial exchange rate risks especially look at Kenya. The shilling dipped one of the highest lows in record. I look at Uganda, I look at Tanzania,
George?
very big challenges as far as Forex is concerned, right?
George, if we look at Barclays Bank, it was out with results yesterday. They were pretty impressive according to the market, but they have put on hold to raise funds of about 2 billion on a medium-term note because of unfavorable market conditions. How badly did the bank need this money?
They really need to recapitalize. That's bottom line. And I think it's quite obvious that right now the global financial industry is quite interconnected, and it's more of a global village in a sort. And so that interconnection actually puts more local banks more susceptible to global shocks. So you realize that in this kind of scenarios, what will actually move a bank forward is its capital adequacy and the liquidity. So for a bank to actually, at the moment, to grow its balance sheet business, they actually need to substantially recapitalize to fund any between 15 to 20% ballpark figures growth in their asset book. So if you look at Barclays, I think if you look at their books between 2005 and 2010, the loan book has not grown. Actually, the loan book has returned cumulatively negative returns. So they need to actually grow that book. So they need to recapitalize. Actually, they need to recapitalize. They need the funds. But now they can't raise the funds. It's the market condition.
Thanks, George. We have run out of time. That was George Bodo, Equity Strategist at Apex Africa.